David, thanks very much for joining us today. You're obviously looking across the various assets. What's your sense at the moment, I suppose, of the impact on coronavirus on the main markets?
Well, it's clearly been a sort of huge impact, but what we've seen since the sell-off in March and the subsequent rally in financial markets has been very much driven by actually the policy response. So both the huge amount of liquidity that's been provided by central banks and also the support provided by governments, either directly to the corporate sector and the household sector through things like furlough schemes and guarantees for bank lending. So that's very much supported not only incomes and the economy, but also been a very important driver of the rally that we've seen in financial markets. But one thing which is also been very much a characteristic of this rally within financial markets is that we're seeing a lot of dispersion. What we've really seen is that investors have still been quite cautious. They've been favouring high grade, investment grade corporate credit. They've been favouring sort of things like US growth stocks, big tech. And it's still the case that there's a lot of sectors such as leisure, transportation, airlines, cruise liners, hospitality, retail, which the value of those assets have really lagged. So I think investors are still very cautious about how many of those businesses and those sectors will kind of survive into a post-COVID world.
And in terms of the real estate, real asset markets, David, are you seeing potentially more of a drive of capital towards these areas?
Well, I think there's been a sort of longer term shift into real assets as government bond yields have declined, not only during the pandemic as a result of all these interest rate cuts, but even before then. And that's been particularly by large institutional investors where they've been seeking not only higher return, but predictable cash flows, and they've been looking at real assets as a source of that, whether it be real estate or infrastructure or timber and sort of other real assets. But it's also the case that the pandemic has induced a obviously winners and losers, as I was kind of alluding to before. So, when we look at some of the sort of commercial real estate investment trusts, we're still seeing, commercial rents at 50% of the levels that they were last year. Part of that is also because of these extended sort of rent holidays. And even in places such as Germany, which has, generally speaking, managed the virus more effectively than most other countries, we're still seeing a relatively slow return to reopening of office centres. And so that's also been impacting the value of those particular assets. So you have a sort of long-term structural trend, which I think will continue and be reinforced by this sort of zero yield world into real assets. But at the same time, you do have winners and losers in terms of your real asset allocation, if you like.
And we've been seeing quite a big, focus on ESG, carbon neutrality, impact investing in the real estate space, particularly. Is that something that's being driven more generally in investment markets?
It's becoming a much more significant and much more important driver. We've seen recently, for example, the German government issuing green bonds, so where they're saying that these bonds and the money raised from them in the market will be dedicated towards environmental projects. And it's certainly the case that us as a Blue Bay, as a specialist fixed income and credit manager, we've seen a very sustained and strong pickup in demand from our clients, so from end investors, for sustainable investment strategies, for demonstrating that we are incorporating environmental, social governance factors into our investment process. And I think that is going to be a trend that's going to continue across the investment space, whether it be in sort of liquid financial assets and certainly in terms of real estate and real assets as well.
It's always interesting to get a broader perspective on the real asset markets, David. So thanks very much for joining us.
Yeah, thank you, Richard. Thanks.